Good morning, dear investors. I'm welcoming you from office of Orion Securities, financial intermediary based in Vilnius, Lithuania. And today it's my pleasure to present together with representatives of the issuer, Lithuanian Central Credit Union bonds, subordinated bond issue. This issuer is actually the largest centralized credit union here in Lithuania. And today, together with me, so representative of Orion Investment Banking, name is Mykantas Urba, we have Rūtenis Šukevičius, who is head of treasury at Lithuanian Central Credit Union. And we also have Eglė Balčiūnė, who is a group CFO of the issuer.
Hello.
So before giving floor to Rūtenis and Eglė, I'll make just a short introduction to the case we have today. So Lithuanian Central Credit Union, in Lithuanian language, Lietuvos centrinė kredito unija, it is the issuer. They are issuing 4 million euro tranche, which is issued under the program of total value of 8 million euros. So the total program, which is expected to be achieved with a second issue, possibly late next year. All the money acquired through this issue will be used as a tier 2 capital to finance the further development of the central credit union. Maturity is quite common for such type of bonds. Maybe just to comment that in recent months we had several issues in Lithuania of subordinated bonds, one by another credit union, one by a local bank. This year in Estonia we also saw a number of these issues. So subordinated bonds, it's quite common instrument here in the market, and the issuer also decided to use this opportunity to finance subordinated debt needs through the capital market issue. The interest rate offered, it will finally be decided by the auction. So it will be either 8% or 8 and 25 decimals of a percent. Investors actually are able to bid, to submit orders, subscription orders at 2 levels. And depending on the demand, if enough demand is at 8% level, the bond will carry 8% coupon. If demand will be achieved through higher interest rate level, then all the orders, both 8% or 8 and 1/4% orders, would receive the same higher level coupon, so 8% and 1/4%. Payout of the coupon is semi-annual, so this is also quite common practice in the Baltic bond market. Short introduction of the issuer, as mentioned, LCKU, Lietuvos centrinė kredito unija, is largest centralized credit union group here in Lithuania. It is uniting 44 members, so 44 separate credit unions, serving actually all Lithuania geography. And what is the role of central credit union? It is a consolidating body, both providing part of centralized services to member unions and also ensuring risk management and to group oversight. So in a sense, acting as a mini central bank, as we discussed, for the whole union group. Talking about numbers, the total assets, consolidated group assets, actually are more or less 1.2 billion euros. Out of it, around 900 million euros are in provided loans, most equally divided between natural persons and companies. the capital is around 95 million euros, and we will see also in the slides that the capitalization of the group is well above the minimum requirements. Nevertheless, the company wants to increase its tier 2 capital to enable further growth. That's why the company is considering issuing this bond placement. Term sheet of the bonds, so most of it I have already covered. One maybe worth mentioning is, of course, early redemption option. Despite the fact that total possible maturity is 10 years, after 5 years, the issuer is given a call option to call the bonds early. And actually, from the practice we see in our market, it is quite likely that financial institutions, after less than 5 years are remaining to maturity, are actually redeeming the bonds, because smaller part of these bonds can be allocated to tier 2 capital. So in a sense, it only becomes as an ordinary debt. And of course, the company is able to borrow much cheaper if it is not subordinated structure. Regarding listing, yes, as usual, for all public offerings, we are implementing these bonds will be listed. Bonds will be listed on First North Stock Exchange. The maximum term is 6 months, but I think most likely it will be done still in early January. So secondary trading opportunities will also be present for this bond issue. Regarding the dates, placement started last week. Orders can be submitted till December 12th, so next Friday. This is the offering period. And on 17th of December, it is an issue date. So semi-annual coupons will be paid on December 17th and June 17th. And after 5 years, early redemption option is possible. And final ultimate possible maturity is 10 years. So redemption in 2035 December. So key investment highlights. What we see in this issue as attractive points is, of course, the issuer itself. It's the largest credit union group, centralized credit union group here in Lithuania, covering all the country with 44 members. It has really significant history of successful financial results, achieving successful financial results. And maybe what's more mentioning is by law, the regulation is quite strict. So the possibility of, for example, having another central credit union is really limited here in Lithuania. So we can say that from a competitive landscape, the position of the issuer is rather protected. It is supervised by the central bank. So in a sense, all the requirements which are applied to common banks are also applied to the central credit union, which of course gives much more credibility if compared with another corporate issuer. And finally, of course, is the balance sheet itself. What I have already mentioned, the company is well capitalized. We have an asset of more than 1.2 billion euros, and capital adequacy ratio is above 14%, which is a significant buffer compared to the minimum requirements. And finally, also worth noting that at the moment, a significant stake of 10% is still owned by the central government of Lithuania. It was provided during the credit union reform, which I guess we also will mention. So it only shows that the state is really supporting the credit union business model, and it is one of the market players, which for sure is to remain and to flourish in our Lithuanian financial market. So that's a short introduction, and now I'm giving floor to Rūtenis.
Hey, hello once again. My name is Rūtenis. Thank you, Mykantas, for introduction. So basically, Mykantas explained what are we offering. I will try to focus more on what we are and why is it worth investing into our subordinated bonds. So the credit union sector in Lithuania is quite different from the one you could find in Latvia or in Estonia. So basically, in Lithuania, we are flourishing, and the total size of the sector is almost 2 billion euros. There are two central credit union groups. So we are Lietuvos kredito, and we are 2 times basically bigger than the other one. The reason for there being two central credit unions is more or less historical. Prior to the reform, there were two possibilities for a credit union. It could be a member of a central credit union or act as an independent member. But in 2016, Bank of Lithuania said enough of this independence. Either you transform into a small bank or you join a central credit union. So as those independent credit unions didn't want to be our members before, so it was quite a natural consequence that they started their own, so to say. So that's how two central credit union groups evolved in Lithuania. Also quite common is the question, what is the difference between credit union and a bank? So in general, there are no differences. A credit union is basically a small bank. Two aspects are worth considering is basically that credit union cannot offer investment banking services, so purely classical commercial banking. And the governance is based on cooperative principles. So one member, one vote. No matter how much capital you chip into the capital base of the credit union, you still have one vote. So basically, there is no major shareholder who could decide the direction of business, the strategic vision, and things like that. The democratic principle of governance is kind of endorsed with this.
Yeah, maybe one more comment. If you have questions, so please drop it in the Q&A interface. We will collect it and answer after we go through all the slides.
Yes, so this is the overview of our group. So as Mykantas mentioned, we are the largest credit union group in Lithuania. We are a central body and we have 44 members. So in total, we have about 100 physical points of access because some of our bigger credit unions, they have what you could call small branches. So this is a tendency quite in contrary to what we have seen commercial banks have done in recent years, especially in more rural regions. They have exited. Sometimes they just exited in total. Sometimes they left some kind of distant customer service. But we see that this physical presence is actually valued by our customers, and they see it as an advantage. So they can drop into a credit union at any convenient time for them. No scheduling, rescheduling. They don't have to drive for 30 or 40 kilometers to the nearest bank branch. And we are exploiting this niche, especially in rural areas. We are historically headquartered in Kaunas because at the roots of the credit union movements, at the time, it was last decade of last century. So after collapse of Soviet Union, farmers couldn't get financing. And that's how a credit union movement evolved. And as our fertile lands start from Kaunas and up north towards the Latvian border, so it was a natural consequence that a central credit union was established in Kaunas. We are about 600 people now in total. If you add central credit union and member credit unions. What is very important is that we have been members of deposit insurance scheme since late 1990s, 1998, 1999. So meaning that deposit in every member of our group, they are insured just the same as in any commercial bank, up to 100,000 euros. As an issuer on solo basis and on consolidated basis, we produce financial statements and according to IFRS requirements, and we are audited by one of the big four companies. Currently, it's Deloitte. So this again shows that we are transparent, and then you can see various data and various notes and all the explanations in our financial statements is set. And in order to bolster the trust and the degree of reliability, we also have a stabilization fund mechanism. I will elaborate on it a little bit more, but it's kind of a supporting scheme to deposit insurance process. Yes, so our business model, as I already mentioned, is mainly commercial banking. So we have in our business planning and in our business analysis, we have three segments of customers: individuals, businesses, and farmers. So we provide all the daily banking services. We provide savings products. We provide various types of loans, mortgages, business loans, investment loans, working capital loans. And we don't get into investment banking and into some very complex and exotic financial instruments. The business model is kind of based on two levels. So our first point of contact with the customer is our member credit union, which is basically a small local bank in a rural area. They deal mostly with customers, and our customers are our members. So we help them, and we have a dual role in helping them. So first of all, we help them to do business, so to say. For example, we are direct members of MasterCard, and this was only possible to achieve. Then the Central Credit Union represents all the credit unions, and they don't go one by one. We are direct members of Centralink payment system, and we clear the payments for all our members. We do kind of for example, joint advertising campaigns, so that no single credit union has to do it on our own. We provide our core IT system. It's uniform throughout the whole group. It's developed by our own programmers, and we develop and maintain it further. It gives us a very good tool to see at any given point of time how our members are doing. Are they doing everything properly? Maybe there are some warnings flashing, and we need to step in before it escalates and central bank notices and things like that. We also design standardized products. There's certain types of deposits, certain types of loans. They are basically uniform across the whole group. And Central Credit Union also has a second role, which is kind of a supervisory role. As Mykantas mentioned, we are like a mini central bank for our members. So they are obliged to keep all their money with us. And we are first line of supervision. So as long as there is nothing really wrong, so central bank wouldn't intervene. We have some powers, our members, to make them work properly. And in order to achieve that, we basically, when it comes to risk management, credit assessment, internal control processes, we provide all the methodology and all the legal documentation, internal regulations at the level of LCKU. We produce them in a central office, and then we just cascade them down to our members. They have an obligation, which is set in membership agreement, that they have to adopt the policies that we design to them, and they work according to them. So basically, it means that the whole group is working under almost identical standards. In the law, in the Central Credit Union law, there is a requirement for Lithuanian Central Credit Union to ensure liquidity and solvency of the whole system. So this is why we look at this task of uniform risk management and internal control systems and things like that. We look very responsibly so that there would be no major issues, and we really have our hand on this. Also, we do and we try to make it as centralized as possible. Basically, if a credit union in a small town doesn't want or simply cannot find a proper AML specialist or internal audit specialist or risk management specialist, so they can outsource those functions to us, and they do that for them. So in this case, basically, we are almost sure that there will be no problems with that member, because we see everything. We do the reports ourselves for that member, and we take the actions ourselves. So we are pretty safe and sure. So brief history, how it evolved. So basically, the key date is 2018. In 2016, Bank of Lithuania started the reform. It came into full force in 2018, and as a result of this, Lithuanian Central Credit Union on solo level and the group on consolidated level, they are regulated as any commercial bank, meaning CRR, CRD, stress testing, procedures, recovery plans, and things like that. So same macroprudential requirements, capital adequacy, liquidity coverage ratio, maximum exposure. And also one thing maybe worth noting, before coming to the market with the bond issue, we thought maybe it would make sense to get a credit rate. So we spoke with the three usual suspects, but there are not that many actually rated companies in Lithuania, and the reason we found out is it's quite expensive pleasure to have. So as we are involved a lot in programs with European Investment Fund, with Council of Europe Development Bank, European Investment Bank, they directed us to a smaller rating agency. It's MFR, based in Italy. They do not do credit rating, they call it institutional rating, but basically they do the same due diligence. We check financial soundness, we check processes, we evaluate prospects of the organization. So the equivalent to S&P scale would be something in between BBB plus and A minus. So we just did it to get the evaluation and how other people see us, so to say. And coming back to our loan portfolio, which Nikantas has briefly introduced. So you see that we have roughly 900 million euros of loans. 500 million, so more than half of the total portfolio, is loans to private individuals, and about 70% of those would be mortgages, meaning well collateralized, issued under standards of responsible lending, which we have in Lithuania, and I'm pretty sure there are in other Baltic countries the same. Also, what we know from practice, what's happening around sometimes. So if there are some bankruptcies, so it's always, you can always expect to recover more from the private individual than from the company. So we see our loan portfolio as pretty balanced in a sense of risk, even tilted towards lower risk end. The reason being that we try to lend only on collateralized basis. So on a group level, about 95% of our loans are collateralized. So there was a question, do you do consumer loans? How much consumer loans you have? So basically the remaining 5% of uncollateralized lending, if you look at 500 million loans to private persons, so we have about 26 million of consumer loans, and that's it out of the whole 900 million portfolio. So naturally, this results in very low or low risk of our loan portfolio. This is the pie chart is based on Lithuanian bank methodology of classifying loans according to the risk group. So there are 5 groups. Very low risk and low risk, they comprise about 80% of our loans. And our provision ratio is 2.2%. So it's a bit higher than commercial banks, but still it's at the very reasonable levels. Also, one would naturally want to know at what interest rates do we lend. So here is an overview of interest rates that we lend to legal persons and private individuals. So basically, it reflects recent ECB monetary cycle. Euribors went up, low rates went up. Now Euribors have come down, low rates have come down as well. So we are on average around 7 plus minus %. So higher than our local biggest banks like Swedbank, SEB, Luminor. Somewhat higher than Artea, but in some cases that we see from competition, it might be that we are not that far away. And so this is our niche basically, where we try to find our customer and give loans. And another aspect I would want to emphasize is the stability of our financing base. As you see, absolute lion's share of our deposits, they come from private individuals, be it demand deposits or fixed-term deposits. And even better picture is that more than 90% of those deposits are lower than 100,000 euros. So meaning they qualify for state deposit insurance scheme. So if there were some turbulence in the market or some rumors about credit union system that something is not good there, so we wouldn't see our depositors rushing to our door and trying to take back the money, because they know that state insurance would pay them in something like 7 days. So we are very well protected against this spiral effect if there is a bank run or something similar. And our cost of funding is actually not that high. So again, it replicates the dynamics of Euribor, went up, now is going down. We lag a little bit compared to commercial banks. They lowered their rates faster. We kept them higher for a bit longer, and we are reducing them at a somewhat slower pace. But at the moment, like good orientation for 12-month deposit would be something like 2.7%, 2.7, 2.8. And the average rate is on fixed-term deposits is 2.61. So our financing base is really stable. It's basically all retail-based and protected by deposit insurance system. And to add more reliability to our picture, as Nikantas mentioned, we are supervised by Bank of Lithuania. Every member on individual level and us, we get inspections from Bank of Lithuania on site, off site. They can ask for some data, some questions just throughout the normal business year. So we are in close cooperation. They know a lot about us, and it would be basically impossible for us if we try to hide something or not disclose. So Bank of Lithuania sees it all. After reform, this unified regulatory framework means that, as I mentioned, we comply with EU macroprudential standards, CRR, CRD, all the procedures in any commercial bank. The membership in a central credit union is mandatory, and then a member enters a central credit union. One of our obligations, as I already briefly mentioned, is to comply with all the internal documentation which is produced by Lithuanian Central Credit Union, and also to be part of a cross-guarantee system, which I will explain in a bit more detail in a few slides. But basically, we have very clear rules on our playing field, and every member knows what is expected from him and how he should perform and what he can and cannot do. And these are like main figures of macroprudential requirements, so capital adequacy, liquidity coverage, and maximum exposure. Yes, the key management is well seasoned, so to say, have a lot of experience. Mindaugas Vijūnas, who is the chairman of the board and CEO of Lithuanian Central Credit Union, has been with the issuer since 2015, so 10 years. Since 2017, he has been a board member and CEO. I also started in Central Credit Union in 2015. I'm deputy head of administration and also head of treasury. My colleague Agne, CFO, is here with me to help me to answer tricky questions. And also Jovita, responsible for business, and Mundas for his management. Yeah, and this leads us to the ownership structure. So, as I mentioned, the first line is credit unions, which have members, private persons, and they can have members, legal persons. So, up to now, absolute majority of the members are natural persons. So, there are more than 120,000 of them, and corporate entities just above 6,000. And they are members of credit unions. Now, the credit unions are, in fact, from a point of view of corporate governance, they are the owners of Lithuanian Central Credit Union because our share capital is comprised of their equity contributions. They buy member shares in Central Credit Union, and of course, then our retail profits and other things. And here on the right side of the slide, you can see this cross-guarantee system. So basically how this works. By law, we are required to have a stabilization fund, which would be used in case there are some problems with one of our members, be it liquidity problems, be it capital adequacy related issues. So each member of our group, us as an issue included, we pay quarterly contribution to the stabilization fund, which by law has to be not less than 1% of the total assets of the group. So if there is some issues, some problems in one of our members, the stabilization fund would just channel the funds needed to the member in trouble. In case the problem is bigger and there are not enough funds in the stabilization fund, each member union would then be asked to pay additional contribution to the stabilization fund. It would be distributed proportionally depending on the size of the member, but they would have to do additional contributions so that it is enough to fix the problems in one or several of our members. And this obligation is stated also in membership agreement. So when a member joins a Central Credit Union, he has to comply with that, and he knows in advance that in case there would be some troubles, he might be asked to pay his share in order to fix the problem. So fortunately, up till now, we do not have examples of practical application of how this works. So we are just accumulating the funds and keeping it. It is detached from the balance sheet of the Lithuanian Central Credit Union, meaning that we as an issuer do not own it. It's a separate vehicle to ensure the financial stability throughout the whole credit union system. So this also, I think, is one of the important aspects to consider investing in us, because in addition to deposit insurance, we also have this instrument, and it is growing. It will grow all the time, and basically we feel very well prepared if anything bad might come up sometime into the future. So I guess this is more or less what I wanted to say about us as an issuer. Maybe a quick look at the financial figures. Yes, so this is on consolidated basis. You see that we have had quite a nice few recent years. Now the tendency has reversed a bit, but it's mostly observed in all other commercial banks as Euribor went down, interest rates, interest income figures have came down, but nevertheless we expect a nice profitable year this 2005. From the balance sheet perspective, as Nikan has mentioned, 1.2 billion, so 900 million euros of loans, 85 million of cash in the central bank, because we are recognized as an eligible counterparty by a central bank, meaning we can participate in all the open market operations on ECB level. So basically we can pledge our government securities and borrow directly from the central bank. And regarding government securities, we have more than 200 million of them as a group. And out of this 200 million, 218 million, about 200 million, maybe slightly less, would be high quality liquid assets, meaning government securities of Eurozone governments, because we act as a mini central bank for the credit union. So we need to have a liquidity buffer. In order, we need to redistribute the money within our credit union group, so we could sell fast without any additional costs. And to basically that sums it up, that we have a well-diversified financing base. We have a well-diversified loan portfolio with a decent portion coming to private individuals. We have nice strong equity base, and we have very good liquidity buffers, and lots of our balance asset side items are diverted into high quality liquid assets. So this is, I believe, a very an investment opportunity really worth considering.
Yeah, also have some standalone.
Yeah, these are standalone figures of us as an issuer, but in general, everybody looks at us as a group on consolidated level. We have some transactions with European Investment Fund, with Council of Europe Development Bank. So when we did due diligence, they always look at us as a group. And yeah, coming back to group level balance sheet statement, on the liability side, where you see subordinated loans, which is 7.4 million in third quarter 2025. These are subordinated loans from European Investment Fund. We have senior loans from Council of Europe Development Bank, and we are also now talking European Investment Bank, but their tickets are maybe a bit too big for us. Now we say, okay, 50 million is standard. Maybe we could go to 30 million, but not less. So we don't need 50 million at the moment in one go, but someday we will get there.
Okay, thank you, Rutenis. Now coming back to the bonds, of course, as always, we ask investors to familiarize themselves with all the risk factors. Full description of risk factors you can find on the information document. Here we have only the summary, but maybe just mentioning what are the main sources of risk for the issuer is, of course, firstly related to the business of the issuer. So it is a credit institution, so naturally credit risk is what the company is designed to be exposed to, and this is the risk the company is managing and profiting from. So of course, loan portfolio, what Rutenis mentioned, it's well diversified, also covered by asset pledges. But nevertheless, if something happens, let's say in the economy, and I don't know, quality of loans deteriorate, it could result in additional losses to the company. Of course, the issue is not isolated from the market and general economy risks. So if there is a market downturn, it could result in not that good financial performance. However, as indicated, the group is well capitalized, liquidity risk is managed, all the requirements are met. So this is a risk really the management is paying attention to. From the structure itself of these securities is, of course, subordination risk, I would say, is worth mentioning. It is as subordinate bonds, it's quite common investment instrument in Baltic markets. As I have already mentioned, at least this year we had several issues, but in a structure, of course, it is a part of capital, so tier 2 capital, meaning that in case of default event, it is a second in line, taking the risk and taking the losses. First in line is, of course, the issuer's shareholders' capital, so equity. Second in line is the subordinated debt, meaning that structurally it is a riskier instrument. That's why we have, of course, such interest rates, but also worth understanding that it is a part of the financial ecosystem, and the issuer is controlled by the central bank. So it is a, let's say, a controlled playing ground, and that's why the subordinate bonds we had in the market, they still quite well accepted by the investors, including institutional investors. Of course, we also have common security-related risks, so it's liquidity, inflation risk, change in interest rate risk. All these factors can affect the market price of the bonds, since, as mentioned, bonds will be listed on Nasdaq First North Stock Exchange. If investors are seeking opportunity to sell the bonds before the maturity, of course, they have to take this price fluctuation risk into account. And of course, other risk, operational risk, it's more or less common and standard ones. So yeah, before finishing our going through the slides part of the presentation, just coming back to the term sheet and stressing the most important numbers. Issue size of the first tranche was up to 4 million. Coupon, as mentioned, it will be either 8% or 8% in 1 quarter, which will be decided by the auction process. So as mentioned, investors can select at which interest level to submit an order. If you do not have very strict preference, of course, we recommend submitting at 8% level, because in case the demand is such that the issuer goes with higher rate, 8 and 1 quarter, all the orders, including those submitted at 8%, will receive the same coupon. So it would, in that case, it would be higher coupon rate. Maturity 10 years, also pretty standard for subordinate debt. Early redemption option is mentioned after 5 years, and from the history of Baltic debt market, we see that it is quite likely that issuers decide to redeem the bonds early. So you should keep that factor in mind. And yeah, it is a public offering, public placement, meaning that all investors from the Baltic states who have financial intermediation agreements, so financial service agreements signed with banks or brokerage companies here in the 3 Baltic states, they can participate in the offering, and they can submit orders as small as for 1 bond, meaning that 1,000 euro is the minimum investment amount. And as mentioned, the offering is going since last week, and it is spanning till next Friday, so 12th of December. So we really urge all the investors to consider this case, ask questions. I see that we already have a number of questions in Q&A. So, and once decided, yeah, submit the order via Nasdaq info system. So yeah, that is the end of the first part. And now we can switch to questions. So maybe starting with quite simple ones. could you comment what determined the issue size? Why the size is relatively small compared to bond offerings we see in the Baltic market? So I guess it's linked to your demand for capital, yeah?
Yes, because this is tier 2 capital. So there is, according to CRR requirements, there is a certain percentage of your total capital structure, which could be tier 2. So at the moment, we can only accept 4 million euros of tier 2 capital. Also, the fact that in end of April, after our annual general meeting, the profit for 2025 will all be directed to retained earnings, basically to reserve capital, and it will be tier 1 capital. So our capital base will increase because we do not pay dividends, which is another quite common question. We don't have any official dividend policies, nothing like that, because there is a legal requirement that 90% of the profits made, at least 90%, they must go to reserve capital to build up the capital base. So as there are only 10% left, no one has ever tried to play with them. And it's a rule of thumb that we attribute 100% of our profits to capital. So yeah, we now can take up to 4 million of tier 2. If we take more, we won't be able to count it as capital. So we will just simply be paying high interest rate for the excess money. We will get some injection of tier 1 in late April. So we think maybe it's a good possibility that we might come back with another 4 million around same time next year, something like that.
Yeah, so just to comment, that second issue would be a tap issue, meaning that the same ISIN number, the same bonds with the same maturity will simply have a bigger number of bonds issued. Okay, yeah, so question also about bonds. What happens if demand exceeds supply? So let me answer that one. As mentioned, we have 2 interest levels at which investors are able to bid. If it happens so that there is a sufficient demand to close the issue at lower interest rate level, then automatically all the orders submitted at the higher level would be cancelled and not fulfilled. If there is still oversubscription at that lower interest level, the issuer has a discretion to decide how to allocate the bonds. In general, of course, the allocation principle would be used to ensure that all investor groups are treated equally, but the issuer has a possibility to give a priority to member credit unions and clients of these credit unions, as well as give a priority to selected institutional investors. But all the other investors, in case of subscription orders, would be decreased proportionally, meaning that there is no kind of time priority principle. It is a proportional allocation rules would be used. Yes, next question, comparison with the banks. So we have both a question from structure point of view and credit point of view. So first, structure, how credit union differs from traditional banks. So maybe a takeaway message is that not that much, except for governance structure, yeah. And actually we can compare like your whole group to a consolidated, for example, financials of a small bank.
Yes.
Not a small, but a bank, comparable bank. And another question, could you provide a rough comparison of the credit union and bank financing terms, for example, residential real estate? How do the interest rates, maturity, and other financing terms differ compared to the bank?
Okay, so as I understand, these are basically mortgages. Yeah. So in a bank, you could expect, if you are a good customer with good credit history, you could expect like Euribor plus 1.5 plus minus, basically. If you come to credit union, the margin would be higher. Basically, the terms, the maturities, the processes are all identical. We all have to comply to responsible lending standards. So just our loans are margins are higher. So I would say instead of 1.5%, you would expect for mortgage 3, maybe 3.5 margin. Of course, it is if you're talking about big cities where apartments are expensive, this makes a difference and competition is harder. If you look to smaller towns where an apartment costs, for example, 40,000 euros, so money-wise, like monthly payment-wise, this higher margin is not that big amount on your monthly payments. So the customers just value the fact that they can do everything basically in their own streets, in their own town. They don't rush around several banks, which are 30, 40 kilometers away in bigger centers. And this is also our niche. We try to be more flexible when it comes to let's say track record. We don't okay, this is mortgages. So no, but in terms of business lending, basically, if we see a good project, it has good collateral and produces good cash flows, and then we see that in the future it will continue to produce, we might maybe not require the full 2-year track record before considering financing it. So we are flexible, more flexible. We try to be faster. We work with smaller cases, which banks sometimes don't want to. And yeah, we know that we are smaller, so we have to move faster, basically.
Okay. Thank you. Yeah, maybe let's talk about credit rating. You mentioned. Can you please elaborate on potential credit rating? You mentioned BBB plus, A minus. Would that be long-term deposit rating and can be compared to Artea's BAA1? So
yeah, basically that would be the same procedure.
Okay, and yeah. Question about maximum exposure. That's the topic we also have discussed. Could you elaborate on the maximum exposure to a single borrower at both the issuer level and the group level? It appears that the exposure at the issuer level is approaching the regulatory limit. So which sector does this exposure relate to?
So we are talking about that slide where it was 15%, I guess. So this is the exposure to public sector, I should say. Basically, these are government bonds of Eurozone government, which is not a member of Eurozone yet. So if the Eurozone member government has euro, so it doesn't create max exposure at all. If their home currency is not euro yet, it creates a maximum exposure. And basically, it happened because there are very strict regulations where credit unions can invest. So we just buy very small quantities of some Eurozone government securities. In this case, as it's not euro as the home currency, it has a bit higher yield. So if each member buys a few 100,000 of that, then you add on the group level, add them on, so it becomes millions, and yeah, and it produces a technically quite different exposure from if you only look at the loan portfolio. So if you eliminate this, which is actually exposure to Eurozone government, one of the Eurozone governments, so our loan portfolio concentration, biggest loan is about 1% from capital. I'm talking on a group level. Top 5 loans are something like 1.9, 1.77. The top 2. Top 5 are 4.4 and top 10 are something like 7.6. So this is the actual concentration if we talk about exposure to private individual, to businesses, and this is exposure to the government.
Thank you. Yeah, we have another question about membership. How strict is the membership to the Central Credit Union? Can the separate unions leave? If yes, is it hard to do? And have you any instances of unions leaving historically?
Yes, it is theoretically possible, and we have one practical example. So basically, You can leave a central credit union only in case another central credit union agrees to adopt you, not adopt, accept you. And just the thing is that you have to give a 2-year notice. So basically, the whole exit process is 2 years. This was intentionally designed by Bank of Lithuania to avoid hopping between central credit unions. And it's a pretty costly process because you have to migrate all the data, things like that. They have different IT system. All the contracts have to be reviewed and then things like that. And we had an instance of one small credit union leaving us to join another one. It was mostly related to the fact that they were closer to Vilnius, where another central credit union is located. So we decided that we are closer to Vilnius, so let's move to Vilnius. So yeah, it is possible. It has happened one instance, but it's complicated and costly.
Okay, thank you. And yeah, we have a final question regarding the credit hierarchy of the bonds. How will this tier 2 rank in hierarchy compare to 8th subordinated loans to other subordinated loans?
Pari paso, what is the term? Basically, same conditions.
So these IF bonds are not preferred?
No.
They stand in the same...
No, we have informed AIF about that and asked, do you need to issue as a separate letter or about that? We said no. Basically, we understand that it will be on the same level, and we don't have any right by a contract that we could require something that our subordinated debt ranks a little bit higher. No, they are at the same level.
Okay. So yeah, thank you, investors, for all the questions. And once again, as mentioned, the offering is running till next Friday, 12th of December. We have answered a number of questions. If you still have any, please submit it by email to either Orion or the issuer. We will happily answer it. And as mentioned, yeah, once you go through all the documentation, we have also informational document available. So once you go through it, familiarize with the issue, we really encourage you to submit an order, which, as I have mentioned, is possible to do through any investment bank, financial brokerage, organized and operating in any of the 3 Baltic states. So with that, thank you for your attention, and yeah, have a nice afternoon.